Welcome to the deep dive. Today, we're jumping straight into, well, a really complex one. It's high stakes, it's Latin America. Grupo Financiero Galicia S.A, GGAL,
That's right.
the Argentine financial giant. They just made this massive acquisition, and our mission today is basically to figure out how GGAL is handling this huge change, this growth, while Argentina itself is going through this incredibly intense economic shift.
It's absolutely a high beta situation. There's no other way to put it. And for you, the listener, getting a handle on GGL, it's kind of like getting a handle on the new risk profile of Argentina itself.
Okay.
We're looking at this unparalleled push for market dominance, this huge scale they've just bought. But, and this is the key, that ambition is balanced against truly massive execution risk. Integrating this thing, that's the challenge. It's a fundamental trade-off, really.
Right. So let's maybe set the stage first. Who is GGAL? It's the holding company, the parent of Banco Galicia, which is the biggest domestically owned private bank.
Correct. But they're more than just the bank.
Yeah, way more. They've got this dual engine thing going on. Four main parts, right? There's Banco Galicia, the main universal bank, then Insurance Galicia Seguros, asset management funds, and the really interesting one, their digital arm, Naranja X.
Naranja X is absolutely critical to their whole strategy. It's their fintech, their credit card platform. Over 6.4 million active users, which is huge in Argentina.
Wow.
And what's fascinating, even before this big acquisition, their edge was combining the traditional solid footprint of Banco Galicia with this low-cost, high-volume digital funnel from Naranja X. They explicitly say they want to be the everyday bank for Argentines.
And they just completely changed the definition of big for themselves. Okay, let's unpack this transformation. The main event, acquiring HSBC's Argentine operations.
Yeah.
Huge footprint, and they're rebranding it now.
Yep, integrating it under a new brand, Galicia Más.
Galicia Más, okay.
And we really need to quantify the scale here, this deal. It instantly made GGAL the undisputed #1 private financial institution in the country, no question.
So what are the numbers?
We're talking pro forma, so including the HSBC assets, about 16.4% of all private sector loans, and roughly 14.7% of private deposits.
That's massive market share.
It's unmatched scale. Huge potential for cost efficiencies down the line. And crucially, it wasn't just about getting bigger retail. The acquisition brought in HSBC's high-value corporate clients, the high net worth base. That diversifies their risk quite a bit.
Okay, but integrated something that big, especially with different company cultures,
Yeah.
that's notoriously tricky. But they made an interesting hire to manage this, didn't they?
They did, yeah. A very strategic move. In September 2025, they brought in Diego Hernan Rivas as the new CEO for the core bank, Banco Galicia.
And his background?
He was the CFO of HSBC Group Argentina.
Ah, okay. So he knows the acquired business inside out.
Exactly. It's textbook de-risking for an integration. You hire the person who, knows where the bodies are buried, understands the systems, the people. It's a calculated shot at smoothing things over, trying to stop the integration risk from blowing up the whole plan.
Makes sense. But look, the company story, GGAL itself, it doesn't happen in a vacuum. We have to connect it to the giant engine that is Argentina's economy right now.
Absolutely.
Zooming out, the whole country is pivoting. This radical shock therapy, focusing on the fiscal side. How is that national shift hitting the banks?
It's fundamental. The government managed to swing from a deep fiscal deficit in 2023 to a surplus. That's huge for credibility. And critically, it lets them start taking apart the capital controls the SIPO bit by bit.
The dreaded SIPO.
And move towards a managed float for the currency. That policy shift completely rewires banking.
And this is where it gets really interesting financially speaking, because for years, maybe a decade, the system was stuck in this, toxic crowding out situation.
Exactly.
Banks basically weren't lending much to private businesses or people because they were funneling deposits, sometimes forced by regulation, into central bank paper, the LELIQs, just to fund the government's deficit.
Precisely. And the shift to a fiscal surplus, it completely flipped that dynamic. Now, we're clearly seeing a crowding in of private sector credit. This is probably the single biggest structural tailwind for GGAL.
And there's data to back that up.
Oh, yeah. The data is clear. For the first time in almost 5 years, this happened in early 2025, the entire financial system's lending to the private sector became bigger than its lending to the public sector. The engine is finally pointing towards businesses and consumers again.
And that structural shift is already having an impact, like actual lending growth.
It's fueling a powerful remonetization. The real stock of loans, so adjusted for inflation, surged, get this, 88.9% year-over-year in March 2025.
88.9%. Real growth.
Yeah. Now, context is key. That's coming off a ridiculously low base.
Right.
End of 2023, private credit was just 7% of GDP. Pathetic.
Yeah, right. So massive room to grow.
Explosive headroom, yeah. Assuming the stability holds, of course.
And on stability, maybe touch on the political side. The midterms.
Right, yeah, important point. The October 2025 midterm elections were widely seen as a stunning victory for the reformist coalition. That gave them a much stronger mandate to keep going with the reforms.
So less political risk.
Definitely led to a significant compression in political risk, as analysts put it. The markets liked it immediately. That political anchor feels, well, a bit lighter than it did a year ago.
Okay, that macro picture,
Mm-hmm.
it almost sounds, I don't know, too good to be true. Usually when things change this fast, there's some pain first. Are we seeing that in GGAL's actual results, the J-curve effect?
Absolutely. You nailed it. The Q2 2025 earnings reported back in August were exactly that, the necessary pain. Net income just plummeted 70% year over year.
70%. Wow. What drove that? Operations collapsing.
No, not weak operations. It was a massive 192% jump in loan loss provisions, basically setting money aside for expected bad loans.
I see. Why so high?
Two things, really. One, the cost of absorbing the HSBC loan book. Some of those assets needed immediate reevaluation and provisioning. Two, the stress from disinflation hitting their existing retail borrowers. Things got tougher for some customers.
Hold on. That provisioning links to asset quality, right? What was their NPL ratio, the bad loan ratio, after the deal?
That's the critical risk metric. GGAL's pro forma non-performing loan ratio, NPL, it stood at 4.4% in Q2 2025.
4.4%. How does that compare?
That's more than double its main competitor, Banco Macro. BMA was around 2.06%.
Ouch. So management says they're taking a big bath now. Sounds prudent. But couldn't that just be spin? Maybe they just bought a really troubled loan book from HSBC. How do we know 4.4% isn't the start of something worse?
That is the core execution risk. You're absolutely right to focus on it. The NPL ratio is the number you have to watch like a hawk.
So what's management saying?
Their guidance is clear. They expect the NPL ratio to stabilize near 5% by the end of 2025.
5%. Still high.
Still high, yes. The bull case, the optimistic view, is that this huge provisioning is strategic. They're being super conservative, building a massive buffer now, sacrificing this year's profits, so they can clean the slate and focus on growth later.
Taking the pain up front.
Exactly. Get it out of the way.
And they even adjusted their growth targets because of this.
They did. Shows caution. They cut their 2025 real loan growth forecast. It was a super ambitious 50%. They brought it down to 30-40%.
Which is still incredibly high growth.
Oh, it's still definitionally high-octane growth, absolutely. But dialing it back shows they're prioritizing getting the integration right, managing the asset quality, not just chasing headline growth numbers this quarter. They have to nail this integration to handle that higher NPL and actually catch that macro wave.
Okay, let's switch gears a bit. Competition. Argentina's banking scene, it's still pretty concentrated, right?
Nah.
An oligopoly.
Yeah, largely. It's dominated by GGAL now, Banco Macro, and then the Spanish giants, BBVA Argentina and Santander Argentina. GGAL's efficiency looks good, though. Their efficiency ratio was around 43.1%. That's strong.
But competition's heating up.
Yeah.
And maybe from unexpected places.
Definitely. Two directions. The one we really need to zero in on is the fintech threat. And it's driven by regulation. We have to talk about Decree 70/2023.
To Decree 70/2023. Okay, what does it do?
This is potentially huge. It allows employees to choose to receive their salaries directly into non-bank accounts. Think digital fintech wallets.
Ah, okay. Why is payroll salary deposits so important for a bank?
It's the foundation. For a traditional bank, those automatic salary deposits are the primary source of low-cost stable funding, the cheapest, stickiest money they can get.
Right, core deposits.
Exactly. So by letting salaries flow straight into, say, Mercado Pago, which is massive in Argentina, or other digital wallets, Decree 70 basically slashes the cost for a customer to switch away from a traditional bank.
So people could just bypass the banks entirely for their main account.
Potentially, yes. They get paid into the wallet, pay bills from the wallet, save, transact, all outside the banking system. This is a direct challenge to GGAL's own fintech, Naranja X. It forces Naranja X to fight not just banks, but these super agile, non-bank tech firms for that fundamental primary account relationship.
That sounds like a serious long-term threat to their funding costs, potentially.
It is. It's structural.
Okay, but balancing that risk.
Yeah.
There's a big positive catalyst for shareholders, right? Something investors have wanted for ages. Dividends.
Yes, finally. The central bank relaxed restrictions on dividend repatriation, specifically for earnings generated from 2025 onwards.
Repatriation meaning getting profits out of Argentina.
In hard currency, yes. For any global investor, this is massive news. Being able to actually get your profits out dramatically lowers the risk perception of Argentine stocks. It's truly a game changer for how these companies are valued.
And GGAL jumped on this immediately.
Instantly. Despite that really tough Q2 earnings report with the huge provisions, GGAL announced cash dividend payments straight away for both October and November 2025.
That's a strong signal.
Incredibly strong. They have
Yeah.
very healthy Tier 1 capital ratio, around 24.0%. So they're signaling confidence. Confidence in their capital base after the acquisition, confidence in future cash flow, enough to start returning cash to shareholders right now. It shifts GGL from being just a speculative growth story where cash felt trapped to potentially offering a tangible yield as well.
Okay, so putting it all together, the macro shift, the acquisition, the risks, the dividend, has the market already priced this all in? The stock isn't deep value anymore, is it?
No, definitely not deep value. The price-to-book ratio, the PB, it's snapped back hard. From crisis lows around 0.3x in 2022, it's been trading around 1.8x more recently, late 2024 into 2025.
Which implies investors are expecting a lot.
Exactly. The market view is completely forward-looking here. Investors are, looking through the 2025 profit dip. That's why the forward PE for 2025 looks kind of high. They're not valuing GGAL on this year's depressed earnings.
They're looking ahead.
To the rebound. They're pricing in the expected massive recovery in earnings predicted for 2026. The forecast is for something like a 34.5% EPS rebound next year, assuming the integration costs fade and that credit growth really kicks in.
Okay, so let's try and synthesize this. The bull case for GGAL. What are the main pillars?
Okay, I'd say three things. First, it's a high beta play on the whole Argentine macro recovery, which now seems politically less risky than before.
Right.
Second, it's plugging into that structural credit deepening. That huge potential for loan growth, the 30-40% real growth target, is central. And third, it's the combination of just unmatched scale now, thanks to HSBC, plus that new dividend catalyst, which makes it more attractive to income investors too.
Okay. And the bear case. The flip side, what's the biggest single threat?
It boils down to one thing: execution failure. Massive execution risk on the integration. That is number one.
And what does that look like specifically?
The immediate fear is the NPLs. Asset quality getting worse than they expect, blowing past that 5% guidance. If that happens, the profit dip wouldn't just be 2025. It could drag on.
So the rebound gets delayed.
Exactly. If integrating HSBC proves way more costly or complicated than they planned, that whole 2026 earnings rebound story just evaporates. And layered on top, don't forget that intensifying competition from fintechs going after those primary accounts, that could really erode their cheap funding advantage over time.
So wrapping up then, the GGAL story. It really feels like a perfect miniature version of the new Argentina itself.
It really does.
Huge growth potential, driven by these deep national changes, but also incredibly high volatility. Success really seems to depend entirely on GGAL managing its own sort of self-inflicted challenge, this massive HSBC integration, so that they can actually benefit from the better macro environment and the credit boom.
Yeah, my final thought on this is really about who this opportunity is for. It's only suitable for investors with an exceptionally high tolerance for risk, and, just as importantly, a really long-term view. You need to be thinking 3-5 years, maybe more.
Right.
You have to be willing to look past the messy quarters we're seeing now, the provisioning pain, the restructuring noise, and really underwrite the potential long-term earnings power after the integration is done.
Okay. And here's a final provocative thought for you, the listener, to chew on. That new rule, Decree 70/2023, letting salaries go straight into fintech accounts. It clearly lowers the hassle of switching banks. So the question is, how long can traditional bank trust the brand value of a Banco Galicia realistically outweigh the sheer convenience and the network effects of a digital leader like Naranja X, or maybe more importantly, an external powerhouse like Mercado Pago? It really feels like the battle for the primary account, the heart of Argentine finance, has only just begun.